what is the piece of guidance going through this that you can say, listen, don't forget this one piece of thing to remember for individual investors navigating a market like today?
Neither panic nor FOMO are investment strategies.
And I'm Andy Cross, the Chief Investment Officer here at the Motley Fool. Thank you all for joining us today on, what has turned out to be just a really incredible day in the markets as investors digest President Trump's wide-ranging tariff policy. And I can't think of anyone better to talk us through that and the investing climate than Lizanne Sonders, the Chief Investment Strategist at Charles Schwab. Lizanne, gosh, thank you for being we're so fortunate to have you today. Thank you for being here. I know you've been
My
all over the
pleasure.
place talking
Yeah.
about these, and it's just a real pleasure to have you. So we got to start when you look at the tariffs and you think about all the factors that are going into that. Do you have any like key questions that you're asking yourself or thinking about the markets today that we can all learn from?
Yeah. So I guess, there's been a lot of focus on the math behind what was
Yeah.
announced yesterday. Not all of it in a positive way.
Yeah.
Given that we're not really talking about reciprocal tariffs here. The
Hmm.
math was basically comparing what the United States exports with a country to what the United States imports from that country.
Yeah.
And here's an example. I think the highest tariff rate, it was as it was defined on that table, was against Cambodia. So goods being imported from Cambodia to the United States. I think their biggest export is something in the textiles and garment area. Well, Cambodia is a pretty poor country. They have about a $7,000
Yeah.
per capita GDP compared to I think 85,000 for the US. So part of the reason why they export more to us in dollar terms than we export to them is because they're an incredibly poor country.
Hmm.
They can't afford what we have to export: services, innovation, technology. But their ability to build an export market in things like textiles has helped their economy
Hmm.
and given something for their workers to have in terms of the ability to earn wages. So the real question associated with that is not so much, why do you want to punish a country like that? But the question is more, okay, when you talk about what concessions the United States might want from these countries on which there's been a high tariff applied to their exports, is how do you negotiate there?
Yeah.
What is a concession that a Cambodia or a Sri Lanka or a Madagascar or a Bangladesh or even a Vietnam can offer in order to bring those tariffs down?
Right.
And that's where I think the question should start to get geared toward. But so far, you're only seeing that on the periphery.
When you think about all of the experiences you've had as the chief investment strategist at Schwab for, gosh, almost 25 years and many more years in the industry
Yeah.
too, you've been through certainly bear markets and pullbacks before. Any learnings that what is driving this one is different than all the rest, but there are things that might rhyme with it or learnings
Right.
that individual investors can take away. What are you hearkening back to from your experiences?
Yeah, and you're right. There, every bear market, every recession, every crisis has different characteristics
Yeah.
associated with it. What we're at least not facing right now is some sort of financial system crisis, or certainly not like a policy era of the monetary variety, which
Right.
can often be a precursor to problems. And sometimes they're related in terms of when you get a crisis within the financial system. Um, this is sort of a policy choice that has significant economic dislocations. And I think what makes this a unique environment is that given the increased probability of recession happening sooner rather than later, that would generally mean you unleash looser monetary policy on the part of the Fed.
Hmm.
And they probably will do that if the deterioration in the economy, particularly the labor market, is significant enough. But that also means they would be potentially fighting against the other part of their dual mandate, which is the inflation side,
Right.
which this tariff policy has implications for that. So it does put the Fed in a somewhat unique position in trying to battle stagflationary type backdrop with traditional monetary policy tools. I also think that there are maybe some memories of the 2000, 2001, 2002 period that should be thought about in the context of what we're experiencing today. Because in 2000, at the peak in the market, at that time, households' exposure to equities was at an all time high. So the 2001 recession that ultimately happened, I think, wouldn't have happened were it not for the bear market in stocks.
Yeah.
We didn't have a lot of economic dislocations. We didn't have a financial system crisis. We had a serious wealth effect crisis by virtue of the bear market in stocks. And I think that needs to be considered today too, because we have an even higher share of exposure to equities by households, an all time record high. And at every income level over the last several years, you've seen an increase in exposure to equities, whether it's through direct holdings or 401ks or pension plans, whatever that
Hmm.
exposure looks like. So I think this the tentacle from market performance to economic performance is a bit tighter than we've seen in the past, save for maybe that 2000 to 2001 period.
It's fascinating you mentioned that because one of the charts that you put up on your LinkedIn, I encourage our viewers to go check out Lizanne on
Thank you.
LinkedIn, is the chart that talks about the drawdowns in the market. But you talk about the S&P 500 or the Nasdaq drawdown, and this is before today. The
This
Nasdaq is
before
maybe down
today.
14% from its highs year to date, but the average position I think was down like 28%. So
Even
the individual contributors are down far more than the
right,
index is down. And so I want to get your reactions because as more individual investors are investing in the markets like those watching today, the index might be down a certain amount, but they're feeling a little
right,
bit more because they're
right.
seeing many more of their stocks down further.
Right. So, prior to today's action, the maximum drawdown for the S&P 500 just year to date has been 10%. It's obviously worse courtesy of today, but the average member maximum drawdown within the S&P is 15 or 16%. Again, that's definitely going to look worse
Yeah.
at today's close. In the Nasdaq, it's even worse. So the Nasdaq at the index level has had a maximum drawdown prior to today of I think 15%. But the average member within the NASDAQ maximum drawdown prior to today was 34% just year to date. So there's a lot more churn and weakness under the surface. Now, one might say, but how can that be? Last year, by the way, last year there was a similar phenomenon. A
Yeah.
year where the S&P was up 23%, the index didn't have even a 10% correction, 8% was the most it was down, but the average member within the S&P had a nearly 20% maximum drawdown. The average member within the NASDAQ last year, calendar year 2024, had a 49% maximum drawdown. The reason why it didn't show up in the indexes was the power of the large cap tech and tech adjacent names, the Mag 7 type of names. So one might say, but they're big laggards this year. They're in their own bear market. How come the indexes are behaving so much better in relative terms than the average stock? And that's because it's still large cap that's doing relatively well. Of the four Russell indexes, large and small value, large and small growth, large cap value has been the best performer. So you still get that cap weighted lift from the larger caps doing better. But it masks a lot more weakness and churn and rotation under the surface.
That's common. If you go back, I'm guessing from you go back years and years and years, you'll see the individual entities of the index be far more volatile than
Right,
the overall index performer. So individual investors who are investing in portfolios or balance individual stocks, it's kind of like, well, you have to understand that's the volatility that you're likely to experience.
right.
Even in a diversified portfolio, you're going to see your individual contributors far more. Tell me if I'm wrong in this. I think it's the individual investors have been still very active in this market over the last, say, 6 months. This to date 6 months, and individual investors maybe or institutional investors maybe not quite as much. Are you seeing a difference between the action from individual investors and institutional investors? And does that have any characteristics of what's happening in the markets today?
Well, it's really hard to segment it out and make that judgment in terms of what percentage of a day or a week's volume is driven by, retail investors versus institutions. You've got a lot of categories within institutions, obviously, everything from hedge funds to traditional mutual
Yeah.
funds. You've got, algo-based and quant-based firms that are trading-oriented firms. So that's really difficult to try to quantify, but there's no question that retail participation is elevated and time horizons among retail investors have shrunk somewhat precipitously.
Oh,
And I'm not sure that that's to the benefit of long term returns because that's trying to play, say, the short term trading game that maybe the algo based firms and the quant based firms have an edge in doing, and also have time horizons in many cases measured in nanoseconds. I think that for individual
yeah.
investors in general, but certainly in a more volatile backdrop like we're in, I think that should reinforce a longer time horizon, not a shorter time horizon.
If you had to give a piece of advice or guidance to individual investors who are, seeing that data and saying, "Oh my gosh, maybe since COVID, the meme stock mentality and a trading mentality and friends in there in and out with different positions." Um, what is the piece of guidance going through this that you can say, "Listen, don't forget this one piece of thing to remember for individual investors navigating a market like today."
Neither panic nor FOMO are investment strategies.
Neither panic nor FOMO are investing strategies. I
FOMO has
love
been a
it.
big driver in the
Yeah.
last several years. You aptly pointed out meme stocks or maybe crypto or the Mag 7 or other kind of momentum chasing. And now we may be in that backdrop where reminding investors that panic is not a strategy. Investment
Yeah.
strategy is important too.